So what is life insurance? Life insurance is a financial contract that involves four different parties. There's the policy owner, the insurance carrier, the insured person, and then their beneficiaries. Life insurance is a contract that guarantees that if the policy owner pays regular payments to the insurance carriers, called premiums, that if the insured person passes away, this insurance carrier will pay a lump sum of money to the beneficiary. The policy owner is the person that will be paying the premiums to the insurance carrier. The insured person is the life in which the insurance is based on. Now, the policy owner can be the insured, but not necessarily. The policy owner could also be the beneficiary, but they can't be both at the same time. So, as an example, a husband and a wife. If the wife has a policy and the husband could be the policy owner, so he would be the one responsible for paying the actual premiums. And if she died, he might be the first beneficiary on that policy. The other example would be if he was the policy owner on himself. So he would be the insured and his wife would be the beneficiary. So you see an example where the policy owner could be the insured and the policy owner could be the beneficiary, but they can't be both at the same time. Insurance is a transfer of risk. Specifically for life insurance, you are transferring the risk of a catastrophic financial situation where your family members basically can't pay their bills. If the main breadwinner or any of the people bringing in money are no longer able to bring in that income. So there are a lot of different options inside of life insurance. Let me just try to break this down as simply as I can. There are two different types. There are term policies, which are temporary, and then there are permanent policies, which are permanent. A temporary policy is a lot more affordable, but a permanent policy builds cash value. Here's a few reasons people might want a term policy. If you have parents with young children, if you have a mortgage that your spouse wouldn't be able to afford if you weren't around, if you're a business partner, or if you're trying to secure some sort of credit. There are two different types of permanent policy. There's a whole life policy, which is basically you will pay this premium for the rest of your life for a guaranteed death benefit. And then there's universal life, which have three different categories, but all of them offer a lot more flexibility than whole life. These categories are guaranteed universal, indexed universal, and variable universal. One thing to know about permanent life insurance policies is that they build cash value. Now, without going into too much detail, because they all build cash value a little bit different, one thing that's very important to know is that life insurance benefits are not taxed. And there are certain ways where you can build up cash value through your life insurance policies that can grow tax-free. There are even some policies where you are able to take a loan against that money that is sitting there. The beautiful thing too about these cash values, on some policies, you don't have to pay this loan back because it is collateralized by the death benefit that is guaranteed by the insurance carrier that you already have a contract through. So these are some of the most powerful financial tools out there, but they are very complicated. They can be very dangerous, but they can be unbelievably powerful. So make sure if you want to get into the realm of dealing with life insurance for cash value, you are dealing with somebody that knows what they're talking about. They know how to structure these policies. And you really also need to understand if you're going to get a life insurance policy for a cash value reason, this is a contract that you cannot let go for the rest of your life. This is a commitment that you have to pay for until you die. There's a whole bunch of ways that you can customize your insurance policies. These things are called riders. A rider is basically an add-on to a policy or a way to customize it. So there's a lot of different options inside of these. One of the most valuable riders out there, in my opinion, is the accelerated death benefits. This rider allows you access to your death benefits if you are diagnosed by a doctor with any of these three illnesses. So these are for critical illness, chronic illness, or terminal illness. Return of premium. If you sign up for a term policy that you end up paying for the whole time and you don't end up using, they will actually give you all of your premiums back tax-free. As a side note, I would not actually recommend return of premium, although it sounds really excellent. If you were to play the numbers, there's a lot better use for that money than just getting it back. And if you get a return of premium policy, they actually charge you a lot more money because they need access to that money to get more interest and make it worth their risk. So they cost a lot more. Long-term care rider is just like long-term care insurance. It's another rider that says in the future, if you need long-term care, they will apply some of your death benefit to the care that you need provided. Accidental death and dismemberment is exactly what it sounds like. If you were to pass away in an accident, they are going to pay a death benefit. If you get dismembered, you will get access to part of your death benefit. Waiver of premium rider is exactly how it sounds. It allows the policy owner to waive the premium payment if they're fully disabled. The spousal term rider allows you to put a policy on your spouse. This is not a joint policy, but an additional policy based off of the health of the original insured. Cost of living rider allows the policy owner to adjust the face amount based on inflation. If inflation is increasing and you don't feel that your face amount is going to provide you the protection that you need, this is a great option for a rider. How you qualify for these things. There's 3 different ways. These are called underwriting. There's fully underwritten, which means generally you have to go get a medical exam, blood work, all of these things. There's simplified issue, which are based on a few lifestyle and medical questions. And then there's guaranteed issues, which if you're under a certain age and you have a pulse, you're going to get a policy. Based on this underwriting, there are 6 different health classifications that the underwriters will put you in. There's preferred plus, preferred, standard plus, standard, and then there's rated and smoker/tobacco users. Your health classifications are going to dictate how much you pay. So going in order, if you're preferred plus, you'll pay the least, and then all the way down to smoker tobacco users, you can expect to pay more. There are 3 different premium payment options. There's flexible payments, which are for more of the advanced products like universal life. There are options where you can design this to get paid up in a certain period of time, usually 10 to 20 years. And then the most common way of premium payment is fixed, which you have a regular occurring premium payment. Generally, these are monthly, but they could also be quarterly, biannually, or annually. Pretty much any life insurance policy can be sold as a single contract, a joint contract, usually between couples, or a group policy. The reason you can trust your insurance companies is because they're the most highly regulated financial institutions out there. And historically, they are the best investors in the market. They know scientifically the likelihood that you are going to pass away. And they have designed it in such a way that you can pay a little bit of money, but you can pay a little bit more than they actually need to cover costs. It makes it unbelievably affordable for you to have this policy, and it also makes it virtually impossible for the insurance companies to lose. And this is by design. This is by regulation. If you look at how many insurance companies failed during the 2008 recession versus how many banks failed during the 2008 recession, I think you're going to be very surprised at how many stuck around. And this is because they are regulated far more stringently than banks, and they are required to carry all of this money on hand, where the banks are required currently to carry 0. Something else that's really important to understand about the life insurance industry is there are 2 different types of agents. There's a captive agent and there's an independent agent. So the way that this works, a captive agent will work for one carrier and is only allowed to sell their products or maybe a few others. You'll recognize these as the State Farms, the Geicos, the Allstates. And then there's everybody else in the market, and they're able to contract with every other carrier on the market that isn't captive. So about 60% of all insurance agents are independent or are brokers. 40% are captive. That's why it's really important when you're talking with an agent to know, are they captive or are they a broker? Because a broker is going to have access to the vast majority of products on the market. They're going to be able to shop around and find the specific products that fit your need and fit your budget. If you're talking to a captive agent, they have very few options available and they're going to sell you whatever they have. So it's really important to understand the difference between a captive agent and an independent agent or a broker.